Good morning, everyone. My name is John D'Antona, and I am the Director of Marketing here at CAPIS. Welcome to our monthly research call. CAPIS would like to thank all of you for taking the time out of your busy day to spend with us here. We hope you find the following information in today's research call useful. In order for us to serve you better, there is a brief survey at the conclusion of this call that we'd appreciate you filling out. Thank you so much for doing that. But before we get started, we're always into the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and/or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy any securities that might be mentioned. And now, on with the call. I'd like to first get ready to turn it over to Nick and Jessica, but before I do, please note that Nick and Jessica will take questions at the conclusion of their remarks. We ask that you please type them into the Q&A portion of your Zoom, and we will be sure to get to them. And here we go. Nicholas Colas is one of two founders of DataTrek, a research consultancy focusing on market fundamentals, designed to make the investment process more profitable, robust, and efficient. Colas is a 30-plus year veteran of Wall Street with experience in equity research, money management, and investment banking. From 1991 to 1999, he was the senior equity auto analyst at First Boston, now Credit Suisse. From 1999 to 2001, he was an analyst and portfolio manager at SAC Capital, reporting directly to company founder Steve Cohen. Most recently, Colas was Director of Research and Chief Market Strategist for first Rochdale Securities and then Convergex Group. Jessica Rabe is the other founder of DataTrek. Jessica started her career on Wall Street working as a research associate for a New York City brokerage firm when she was 19. She was vice president of market strategy at Convergex Group prior to co-founding DataTrek. Jessica wrote economic and market commentary for the Morning Markets Briefing, a daily financial report widely followed by the investment community and media. She is also co-author of Alts Democratized, a practical guide to alternative mutual funds and ETFs for financial advisors, published in 2014 by Wiley Finance. Nick and Jessica, as always, welcome.
Thank you very much, John, and thank you all for taking the time to listen in. Jessica and I have 5 topics to cover today, pretty wide-ranging from U.S. equities to macro issues and issues in the labor market, especially, which Jessica will cover. So it's quite a chunky agenda, so let's just dive right in and get through it. I want to start with U.S. equity valuations. And look, the bottom line, everybody on this call knows one existential fact. U.S. equities are super expensive right now. They're more expensive than they should be at this part of the economic cycle. Let me just walk you through the numbers. The street right now is at $221 a share on the S&P for next year. Let's assume that's low because the street's been low all year long. So let's assume it's 10% better and it's $243 a share. So $240 a share of S&P earnings. By the way, that's against $160 a share in 2019 before the pandemic. So a big uptick in earnings power. That's still 19 times forward earnings. That's higher than any point in the last cycle in terms of equity valuations from 2010 to 2020. You'd expect to see high valuations at a bottom because markets always underestimate earnings power at the bottom, but we're 18, 19, 20 months off the bottom, and we're still trading at 19 times earnings. So that's pretty expensive. We recently did some analysis for our clients using the same kind of approach, but using Shiller PEs. And Shiller PEs are basically just what does the S&P trade at versus its average of the last 10 years of earnings power. So take the last 10 years of earnings, average them out, divide that into the S&P, that's your Shiller PE multiple. The Shiller PE multiple right now is 40 times, 40, more than twice expected forward-year returns, forward-year PEs. And that's extraordinarily high. The mean Shiller PE back to the 1800s is 17. 40s only happened once, and you can guess when. It was the dot-com bubble. And it's only happened that one time again back over the last 100+ years. And here's the catch, and here's the problem essentially. The S&P's never had a forward 10-year return that's positive when it starts with a 40 PE. Now, granted, it's a small observation set. It's just the years around 97, 98, 99, and 10 years forward. But that's when valuation begins to really harm the possibility of actually making money in the S&P over the next 10-year period. So if you're thinking about being a long-term investor in US equities, these are very difficult valuations to justify having any kind of weighting in US stocks, or you need to have the most minimal weighting you possibly can. However, valuation is just math. Math is not an edge. If you've got a calculator, you can do this and do that analysis, which means everybody can do it. So to me, the more valuable thing to understand is just what's going on in the market that is causing these high valuations. Now, you can point to a lot of liquidity, you can point to Fed policy, fiscal policy, and that's fine. There's a lot of money rolling around. But again, everybody knows that. So what are the fundamental underpinnings of this revaluation of US stocks? And to me, there's really kind of two explanations for why it is justifiable to have high valuations. I'm not being an apologist for the market, but there is a solid explanation for this, and it's simple. The S&P is doing 13% net margins right now, 13%. It's never done 13% reliably before, ever, period. The average of the last cycle was 10, 11% net margins. So from 10 to 11% net margins, we now are holding 13% net margins the last 2 quarters, wildly higher than we've had at any point in history. And the same data, by the way, you can get from looking at corporate profits as a percent of US GDP. Usually companies, this is all companies, not just public, all companies in the US make somewhere between 7 to 9% of GDP as profits. That's a nice reliable band. It can go up and down over a cycle, but that's the band. So 7 to 9%. We're doing 11% right now, 11%. So we are way over earning our usual corporate profitability in terms of private companies making money in the US economy. Part of that is obviously internationalization. There is more international profits now than prior cycles, but there's no doubting that US companies are earning significantly more than they have at any prior point, period, full stop. This is peak profitability. And you can say that going back to World War II. That means valuations are going to be high because markets will try to be discounting how much of this is sustainable. And there is an argument to make for that it can be quite sustainable. And let's talk about that. Inflation is the key thing to focus on here. So if you think about the 1970s as kind of the exemplar decade of inflation, overall from 1972 to 1980, kind of right before the first oil shock to the end of the second one and all that inflation in between, inflation rose by 110%. So basically doubled. Corporate profits were up 120% over the same period. So inflation did allow companies to hold and modestly expand profit margins. And the S&P was up 90% from 72 to 80. So it kind of didn't beat inflation. It's only because of the 73, 74 bear market, which was a down 37% 2-year bear market. So if you had just bought anywhere into that decline, you would have beaten inflation owning equities. So to my thinking, inflation is actually right now being discounted as a modest positive for corporate earnings and therefore corporate margins and therefore corporate returns and therefore stock prices. Now, you can argue, okay, that's just ridiculous because you can't sustain those margins, but the market is saying there's a possibility. So that's the framework with which to think about the market. The second explanation, and it's kind of tied to the first but with a wrinkle, is the tech sector. So all of S&P tech plus Amazon, Facebook, Google, and Tesla is 41% of the S&P, 41%. At its peak in 1999, the tech sector was only 29% of the S&P. So we've gone from 29% in the old dot-com bubble to 41% now. And it's climbing. It's climbing virtually every month, if not every week in the last couple of month rally. So tech is just more and more. And tech is different from the rest of the market for two reasons. First, it tends to have very high returns. So Google, Facebook, Amazon not so much, but Google, Facebook, Apple, and Microsoft have fantastic returns on capital, 25 to 30%. And they can reinvest a lot of capital into their business. They can buy back stock with some cash flow and reinvest in their business with the other cash flow. And that creates very high compounding rates. Those are worth more. That's why that sector trades at a higher multiple. The bottom line here is both of these explanations, both the corporate profit explanation and the tech explanation in the S&P, lead to kind of a similar conclusion. This market is discounting a quasi-permanent shift in corporate profitability. And it's not just tech, it's everywhere. The expectations are that pretty much every sector is going to have higher margins post-pandemic than it did pre-pandemic. And that'll get us to our 12 to 13% net margins versus the old 10, 11%. And the second assumption that the market is using is reinvestment rates are going to be higher, partly because tech is more of the S&P, so a better sector to reinvest capital, but also because the market expects a ton of stock buybacks. And that's rational. You know, we're getting a lot of excess cash flow. When a company goes from making 10% net margins to 13% net margins, that's a 30% increase in total income, but a much bigger increase in free cash flow. So if all that free cash flow gets used to buy back stock, you have a natural source of demand and a naturally higher reinvestment rate than you would otherwise. So the bottom line on this conversation on the market is if you don't like these explanations and you think that it's really just a bubble, we're getting to the point where valuations say you have to start scaling out. The old peak on the Shiller P was 44. We're at 40 now. Mathematically, that means we have another 10% move in the S&P, and then we hit the old 99 peak bubble levels of valuation, and a sell-off will ensue. And you can, if you want to, tie that to Fed policy. So if you're worried about the Fed raising rates aggressively next year because of inflation, that's the logical catalyst to say, okay, the S&P bubbles up into the end of the year, and then we get a lot of Fed rate increases and the market rolls over, very much like 2000, by the way. That is kind of like the carbon copy of the 2000 playbook. We're not as bearish as this. I do believe that the valuations driven by tech are valid, are sustainable, and are based on corporate finance reality. So we're not as bearish as all that, but I wanted to start with this section because it's a really important conversation to have as you think about 2022 asset allocations, equity allocations. And the valuations really are extreme. I had this conversation with a group of very senior private equity managers earlier this week here in New York. And it's exactly the same situation in PE, in venture capital, in leverage finance. It's everywhere. Valuations are stretched everywhere in capital markets simultaneously. So that's why I wanted to lead with that. Now, let's move on to the 4 questions that were posed by CAPIS professionals to us to discuss on today's call. The first was ongoing supply chain issues, especially related to the holiday. Are there any effective ways to ease the supply chain issues? And what does it mean for corporate earnings? So let me take a quick step back to discuss very briefly why we're having supply chain issues. And it's a compounding factor coming from both the supply and demand side. The first is that we never really had a demand recession in the US. And so we had a downdraft in demand because of the pandemic and because of shutdowns, but because of fiscal and monetary policy, it came roaring right back. And that was a surprise to pretty much everybody in the industrial economy around the world. They had budgeted for a big drop in demand because that would have been logical. And so the supply chain globally was not set up to deal with a snapback in demand that we got in the back half of last year and into this year. So basically you had a shortfall in production, amplified demand, and the mismatch is the supply chain problem. On top of that, you've had a persistent labor market problem in the US, and Jessica will discuss more about that in her section, but a labor shortage or persistent labor shortages are also creating supply chain disruptions. You don't have enough people in retail stores, in the service economy, in airlines, and that's all creating a problem as well. My bottom line on this is not going away anytime soon. This is not a 3-month issue. This is a 6 to 12-month issue at the best, if for no other reason than the labor issues that Jessica will discuss. The effect on holiday is pretty straightforward. We've already started to see it. Holiday spending started in October. That's very clear from the retail sales data. It'll extend into November, and then December could be a little bit softer. The NRF is looking for kind of a flat holiday spending season anyway, and that's logical given that last year's holiday shopping season was probably over amplified by a lack of house parties and family get-togethers and office parties. And so the system had more money to spend on presents. That's going to get rolled back a little bit this year. And so we're thinking holiday is going to be flat in terms of overall consumer demand. At the same time, there's a lot of pessimism in the market about Q4 earnings. I think partly driven by supply chain issues. And I'll put it to you this way, the analysts who cover the S&P stocks are thinking margins are going to decline from 13% in Q3 to 11.8% in Q4. Basically 110, 120 basis point decline. That is a huge drop. We have not had that kind of drop in margins at all, either in the last couple of years before the pandemic or as the pandemic has kind of rolled through the economy from the bottom for margins in Q2 and Q3 of last year. So they're very pessimistic. We're not as much so. Between inflation and efficiencies in distribution where they have to be, you're going to see margins hold up pretty well in Q4. You've also had companies, I think, do a lot of over accruing of expenses this year, wondering how the economy was going to go. And I think those accruals are going to get released in Q4, and that'll also buffer margins. So we're not as pessimistic as the street, but to answer the question about how holiday and supply chains is going to hurt Q4, the street's quite pessimistic, thinking over 100 basis points of margin contraction. We're not as much. And we've been very confident in corporate margins all year long. And that's served us very well because it allows us to call the strength of Q3 earnings and the strength of the market as a result. Second question, and this one relates to inflation and Fed tapering and rate policy and what effect any new infrastructure spending is going to have on inflation. So here we use Fed funds futures markets as a proxy for market expectations, and anybody can do this. If you go to CME Fed Watch, you'll get a nice bar chart of every Fed meeting over the next year plus and what the odds are of rate increases at every Fed meeting. So that's the data that we use. The bottom line here is the market expects tapering to be done by May or June of next year. That's where the odds of the first rate increase flip from being less than 50% to more than 50%. The Fed's not going to raise rates until they stop buying bonds, so tapering has to end before rate increases begin. But the market is very clearly saying that the Fed is going to immediately start raising rates. Whether it be June or July of next year, you're going to see your first rate increase in roughly 7 months. And that is almost a dead certainty because of inflation, because inflation continues to track higher. Additionally, the market right now is kind of 50-50 odds on whether there's going to be 2 rate hikes next year or 3. So either one, I think, is acceptable to the market as long as the economy is continuing to grow and as long as the Fed is not pushed into a 50 basis point increase. That's where things get hairy. For those of you that remember April 94, that's what happened in the 94 recovery or 94 rate cycle. The Fed moved by 50 basis points. That took the market totally unawares, as it would now. And that's what you don't want seeing the Fed do. I don't think they will, but that's an important consideration. So as long as the economy is growing, even if inflation is quite high and the Fed only moves by 25 bips 2 or 3 times next year, that is totally in market expectations, not anything to worry about. Now, what are the issues? Inflation obviously is the issue, running quite hot, 6.2% CPI last month. We think you're going to see 5 to 6% inflation pretty much all the way through the next 12 months. The math behind the CPI calculation very strongly points to it. It could get to 7%, honestly, because housing inflation, what they call the owner's equivalent rent and CPI, can accelerate quite quickly. The OER calculation is based on surveys of homeowners asking how much they could rent their house for. And the surveys tend to be very subject to popular perception. And I think everybody understands that housing inflation is quite high. So you could see a 7% CPI print next year. I don't think it'll unduly worry markets, but it might push the Fed to act more quickly. So that's, to me, the open issue. As for infrastructure spending, we're not especially worried, honestly, that you're going to see a lot of incremental inflation because of infrastructure spending. Takes a long time to get these projects going, takes a long time to hire, to allocate resources. That's less of an issue for us. We're more worried about housing inflation and what effect it'll have on CPI and on how the public perceives inflation. We're also frankly worried about food inflation. Food inflation is running 10% year over year. Protein inflation is running more. And it's run at a compounded rate, I think, of close to 8% over 2 years. So food is a lot more expensive, and that also informs people's perceptions of inflation. So we're going to be talking about inflation well into next year, but the real issue for markets is how does it affect Fed policy? Because as I mentioned, on a corporate profit standpoint, in a recovery, inflation's fine. Do not worry about margins getting crushed by inflation. Companies pass through inflation as long as the consumer is in good shape, and the consumer is in very good shape, regardless of sentiment. The consumer is spending, the consumer is using their savings, they're purchasing things on credit, they're doing all the things they usually do in a recovery. My third point, and then I'll hand it over to Jessica, is there was a question on the outlook for ETFs, specifically Bitcoin ETFs. So let me just start with a macro comment. We look at money flow data into US equities on an aggregate basis, not just ETFs, but mutual funds as well. And the only way to describe mutual fund and ETF flows into US equities over the last 6, 8, 12 weeks is amazing. The strength is something that we have not seen in a long time, not months, but years, many years. We're seeing, in many cases, over $10 billion a week of incremental inflows into US equities over the last 6 weeks between mutual funds and ETFs. Now, keep in mind, flows have been negative out of US equities from ETFs/mutual funds for over a decade, and to the tune of $20 to $40 billion every month, no exception, or rare exception. I think 2019 had 2 positive inflow months. Everything else was very negative. And that's because the folks that bought mutual funds in the 80s and 90s are getting older and rebalancing to fixed income, and that was the way money flows worked. But in the last, I want to say 6 months, maybe 8 months, you've seen this turn. And you've seen money flows into mutual funds and ETFs turn positive. ETFs get a lot of the incremental market share because they're more efficient, tax efficient, fee efficient. But the message is the flows are positive, and not just for ETFs, but for total aggregate fund flows, very positive. And as long as the S&P continues to rise, it's very clear that money flows will stay positive. We're seeing the same thing in single stocks with single stock traders, but it's being mirrored in the mutual fund ETF world as well. On Bitcoin ETFs, I mean, I think the question is probably when are we going to see either more Bitcoin ETFs or a Bitcoin cash ETF versus a Bitcoin futures ETF? And I'll just say that, I've been looking at this topic for a long time. I started covering Bitcoin in 2013, and Convergex, my old firm, was a huge ETF AP, authorized provider. Authorized participant. And so we did a lot of work on figuring out if you could do a Bitcoin cash ETF. And the short answer is it's really hard because of one thing, the close. How do you get a reliable closing price? That's the problem with a Bitcoin ETF, because there's so many exchanges around the world that there is no 4 o'clock, 4:15 hard asset price close. Bitcoin just keeps trading 24/7. The futures market allows you to get around that because the futures market does have a close and a lock that you can price the ETF off of. So it's going to be hard to get a Bitcoin ETF, honestly, because of that closing price feature. It's very important to the SEC to have a very hard, auditable 4 p.m. close. And that's very hard to do with Bitcoin. So that's it for my formal comments. I'll turn it over to Jessica now. Jessica is going to be answering the question, and I'll just read it out loud, and then Jessica will give the answer. What about the jobs outlook in the U.S.? As we've emerged from COVID, unemployment has been, kind of a mystery. Jobs are still unfilled. Hiring signs abound, but there seem to be few takers, and people are growing acclimated to fewer workers and diminished service. So what's going on, and what's the job outlook for the U.S. over the next 12 to 18 months? I'll turn it over to Jessica.
Thank you, Nick. So our answer for this question really comes down to 2 factors. The first is that working in service sector or healthcare jobs is now far less attractive given the challenges that they pose amid the public health crisis. The second is that people have reprioritized how they want to work in a post-pandemic world. Now, let me just take you through the data so you can see how we came to these conclusions. To set up the conversation, I just want to point out that workers continue to quit their jobs in record numbers. What we call our take this job and shove it indicator, which is a measure of quits to total separations, rose to a record high of 71.3% for a fourth consecutive month in September, which is the latest available data. Now that's super high. To put it in context, the pre-pandemic high was 63.4% in 2019. Now, the latest record figure was due to an all-time high in quits as a percentage of the labor force and a near record low in layoffs and discharges as a percentage of the workforce. Meanwhile, job openings as a percentage of the labor force are at 6.5% versus a pre-pandemic high of 4.7% in 2018. So job openings are extraordinarily high relative to history. So the US has a record number of quits and near record job openings simultaneously. Now there's two major reasons why employers are struggling to both attain and retain workers in the current environment. The first is that industries that were hard hit by the pandemic, so leisure and hospitality, retail, trade, and education and health services account for half of all quits this year. And these industries make up over a third or 37% of total non-farm payrolls. So they are very important industries to the overall labor force. Now, the reason why workers continue to leave service sector and healthcare jobs is due to a raft of challenges or contentious demands, including mask and vaccination requirements. And of course, a lack of childcare access or concerns about contracting the virus have also been major factors. And on top of all of this, labor shortages compound these issues as existing staff gets overworked and quit as a result. The second reason for employers' workforce difficulties is that many people have reconsidered how and where they want to work in a post-pandemic world. A big part of this is that Americans no longer want to endure long commutes, given that the average commuting time a day is just over an hour. They want to reclaim that time and have more flexibility during the day. And as a result, average American office occupancy is still only back to 39%. And major cities like New York and Los Angeles are only at around 35%. That shows workers do not want to go back to the office, at least not full time. And companies are now being forced to make concessions or risk losing employees to other companies that will. Now, this is very unique to the US. Office occupancy data for Europe's major cities shows higher levels of around 50 to 80%. So remote and hybrid work is a US phenomenon, and this is not going away. These dynamics are here to stay, at least in the near term. So we do think that the labor force issue to watch in terms of we think the labor force issue to watch is how it impacts US labor productivity over the next decade. That'll be really important to keep an eye on. So to wrap up, this has been the most unusual US economic recovery in history, given such massive both fiscal and monetary stimulus. That's given workers a lot of leverage in the current environment to quit or stay away from jobs that are not as compelling as before the pandemic, such as in healthcare or the service sector. And it's also allowed professionals to switch jobs in order to gain a more conducive work-life balance. And like I said earlier, these dynamics are not going away anytime soon. So that will make labor shortages and high employee turnover persist, at least in the near term. With that, I'll hand it back over to Nick.
Thanks very much. John, any questions?
Yeah, I've got a couple here actually from the floor. The first one is in our chat Zoom. How do you think supply chain disruptions and the market will be further affected by holiday shopping? Either one of you want to take that?
Nick, you there?
Yes, I think I just dropped off for a second. So John, if you
Oh,
could
okay.
repeat the question. Yeah.
I'm sorry about that. The question is, here, I have a different one. Let me start with this one. It's shorter to read. Could you talk a little bit more about these continental differences between return to office rates, and why is this only a US phenomena?
Yeah, it's a great question. We've spent a lot of time kind of thinking about that. So here's how we think about it. The average American works around 200 more hours a year, direct work than a European worker does. And this differential has been in place for the better part of 50 years. Americans just structurally have a longer work day. Commute times are about the same, honestly, between the US and Europe. So if you look at commute times in the US, Jessica cited the roughly an hour commute. It's about the same across Europe. It's actually higher in some countries, a little bit lower in others, but it's pretty equivalent. So American workers have the same commute, work an hour extra day every day of the year, also take less vacation. And so for many years, I think that was everybody just thought, okay, that's just the way things are. But the pandemic allowed us to see a different approach. And that was the hybrid office, the hybrid work from home solution. And people really like it. And so there's also a feeling in Europe, I think, that European workers feel a little better about their relationship with their employer than the US does. There's more of a long-term tenure arrangement in Europe. There's less labor market turnover. And so there's a lot more social safety nets, particularly in the Northern European countries. So you end up with a situation where European workers, office workers or blue collar, were pretty comfortable and pretty happy with their work arrangements pre-pandemic, and they're happy to go back to them. So when I last looked at office occupancy rates for Berlin, Paris, and London, they were between 50 and 80%. Some quotes were even as high as 90%. European urban centers are largely back to work. The traffic data that we track also mirrors that. In the US, it's just not happening. And it's not happening not by a little, it's not happening by a lot. So the office occupancy levels here, 39%, New York, 35%. We're still well below half. It tells you there's something different. The occupancy rates are different. The traffic levels are different. The mass transit ridership between the US and Europe, we also track that data. It's also different. So what does it mean? Why should we care? We care because population growth and productivity are the only two drivers of GDP growth. That's it. That's the whole equation. If you have more workers and they work more productively, you get GDP growth. We have very slow worker population growth in the US, only about 0.7%. We need the rest of GDP growth to come from productivity. And it's an open question whether or not the US economy is going to be as productive in a hybrid approach as it was in a fully in-office approach. The academic work is pretty sparse. There's some consultants that talk about this and say, if the company is very well run with seasoned
I think we had a drop off again, Nick.
Oh, there he is.
Sorry, I guess I dropped off.
It's okay.
So productivity growth, it comes down to productivity growth. Can we have as good a productivity growth cycle in this decade as we had in the last couple? Remains to be seen. No one knows. And that's why we track it so much. That's why it's important. That's why work from home is important. That's why this trend that only America is really going through is important.
Okay, in a related question, one person sent to me via email, can higher wages rescue us here?
Higher wages are very helpful as long as we don't go into a recession. As long as economic growth is there and wage growth is there, yes, it can absolutely be helpful. Some of it gets eaten up in inflation, but again, the inflation is good for corporate profits. So short answer, yes, it's helpful.
Okay, and another question here. This one, we're shifting to China. What is your updated view on China? I keep hearing about Evergrande, but does this really seem like China will let anything drastic happen given state control over industry?
Yeah, let me give two short answers, and then Jessica's also done some work on this, and I'll let her backfill with anything I forget to mention. The short answer on China is it's still a problem. We're still in a transition phase from what was a hyper growth economy, especially during the pandemic for a lot of industries, education, e-commerce, ride hailing. A lot of the hot buzz things that were hot in the US were hot times 10 in China. It's a much bigger market, 4 times the number of smartphones, huge population. And the government's still working to reset the balance between private sector and public sector importance in the economy. So it's not ending anytime soon. I do, however, I just actually finished reading a great book about the Japanese economy over the last 20 years, and it does feel a lot like China is going down some of the same path as Japan did in the post-bubble phase after 1989 in the Japanese economy. Slowing population growth, a lot of bad debt, a lot of unwillingness to take bad debt write-offs, a lot of support of zombie companies. So we're not very positive on China over the medium term for those reasons. And I think the point made in the email is right. Evergrande is kind of like the tip of the iceberg, but it reflects an overstretched real estate market with a real unwillingness to just accept the facts that there's a lot of bad loans out there, take the bullet, write them off, and move along. For better or worse, the US did a very good job with that after the financial crisis. You know, it was clumsy, but it worked. Japan didn't, and they suffered. And it's an open question which side China's going to be on. Jessica, anything else on that?
Yeah, Tencent's president was out within the past couple of weeks, just saying that as more companies adapt to regulations, the impact on these industries will be less and less over time. But overall, you still do see public statements from major Chinese tech companies be very cautious, and they should know better than anyone because they're the ones that have to work closely with these regulators. So I just say there's still a huge overhang of uncertainty on Chinese tech companies, and all you have to do is really look at China's big major the way that China's big major tech stocks are trading. They continue to tread water. That's been the past few months, and again, it's just this overhang of regulatory uncertainty.
Okay, and I don't see any other questions here. If that concludes our questions, we'd like to thank everyone for being a part of the CAPIS monthly research call. Our next call will be on December 16th, featuring Katie Stockton of Fair Lead Strategy. So we invite everyone to please stay tuned. Again, thank you very, very much to Nick and Jessica for being a part of today's call. And on behalf of all of us and everyone here at the CAPIS family, we'd like to wish everyone a very happy and safe Thanksgiving holiday next week and a great trading day. Thank you very much, everyone. Have a great one. Bye-bye.